Have you ever seen a stock shoot up for no reason, only to crash moments later, wiping out thousands of investors? Or maybe you have put your own hard-earned money into the market, only to feel like the game is somehow rigged against you? That feeling of being played is a huge problem, and it's exactly why I made this video. The solution isn't to run from the market, it's to understand the rules of the game that no one talks about. Today we are going to explore the 4 hidden dynamics that truly control the market's biggest moves. By the end of this video, you won't just be aware of the dangers, you will have the clarity to spot them and the knowledge to protect yourself. So without further ado, let's go ahead and dive in. Alright, before we dive into the shadows, we have to ask a simple question: why does the stock market even exist? Is it just a giant complicated casino for people in suits to bet money? That is what a lot of people think. But the real reason is actually much more important and frankly much more interesting. To understand it, let's forget about Wall Street for a second. Imagine your friend Jack is an amazing baker. He wants to open a coffee shop, but he needs $100,000 to get it started. For the rent, the ovens, everything. He only has $10,000 saved up. The bank won't give him a loan that big. So what does he do? Does the dream just die? Well, Jack has an idea. He divides his future coffee shop business into 100 tiny equal pieces. He keeps 10 pieces for himself and he offers to sell the other 90 pieces to friends and family for $1,000 each. Each one of these little pieces is a share of his company. We call it stock. Now, if you buy one of those shares, you aren't just giving him money, you are becoming a part owner of his coffee shop. You literally own 1% of it. If the coffee shop becomes a huge success, the value of your piece goes up. You could sell it to someone else later for way more than you paid, but if it fails, you could lose all the money you put in. That's it. That's the core idea. The stock market is a giant organized marketplace for huge companies like Apple, Amazon, or Tesla to do the exact same thing Jack did. They sell tiny pieces of their company to millions of people all over the world to raise billions of dollars. They use that money to invent new products, build factories, and hire thousands of people. So at its core, the stock market isn't about gambling, it's about funding dreams and building the future. Now that we understand the theory, let's see what does this mean for you when you actually buy a stock. When you buy one share of a company, you aren't just betting on a symbol on a screen. You are becoming a part owner of that business. You own a tiny fraction of every patent, every office building, every employee, and every dollar of profit. Your goal as a part owner should be for the actual business to do well over the long term. With that being said, this simple powerful concept has a dark side. The problems start when the price of a share becomes disconnected from the actual value of the business. This happens when people stop thinking like owners and start thinking like gamblers. They are not asking, is Jack's coffee shop selling more coffee this year? Instead, they're asking, can I sell my piece to someone else for a higher price tomorrow even if the business is struggling? That shift in mindset from investing in a business to just betting on a price is the doorway to everything we are going to talk about. It opens the door for hype, fear, and manipulation. And that brings us perfectly to our next point, where we will see how the biggest players can use the system for their own gain. Let's dive into the world of market manipulation. So, we have established that the stock market at its core is a tool for funding businesses. But what happens when the tool falls into the hands of someone who wants to use it as a weapon? Have you ever watched a stock price move on so fast and so strangely that it just does not make sense? It's a feeling that you are playing a game but someone else knows all the cheat codes. Well, in many ways, you are. Today we are talking about market manipulation by the biggest players on the field, the hedge funds, the big banks, the whales of the financial ocean. To understand their impact, we first need to look at their unfair advantage. Imagine the stock market is a giant grocery store. You and I walk in, look at the prices on their shelves, and decide what to buy. Now imagine a well investor can sit in a back room with a supercomputer that shows them the store's entire inventory in real time. They know when the next delivery truck is coming and they have enough money to buy every single carton of milk in the store in less than a second. That is the kind of advantage we are talking about. They have 3 things we do not. First, massive amounts of capital. They can buy or sell so much stock that they literally create the waves in the market. Second, information. They have entire armies of analysts and access to data we will never see. And third, speed. Their computer algorithms can make millions of trades before we can even blink. Their goal isn't always to invest in a great business, it's to exploit tiny price movements for enormous profits. Now, this isn't just a theory, let me use a famous real-world example. Remember the flash crash of 2010? In a matter of minutes, the US stock market suddenly lost almost $1 trillion of value, seemingly for no reason, only to recover moments later. For years, nobody could fully explain it, but a huge part of the blame was eventually placed on a single trader named Navinder Sarao, operating from his parents' home in London. He used a custom-built computer program to do exactly what we just talked about, placing huge fake sell orders to create the illusion that the market was about to crash. This tactic is called spoofing. As other computers and human traders saw these massive sell walls, they panicked and started selling for real. This pushed prices down, and in the chaos, Sarao's program would cancel the fake orders and buy up assets at ridiculously low prices, profiting when the market snapped back. This one trader using these manipulative tactics helped trigger $1 trillion flash crash and made over $40 million in legal profits. He didn't just predict the panic, he manufactured it. With that being said, if the game is rigged, how can you possibly win? This is the most important part. You do not win by trying to play their game. You can't outrun a supercomputer, you can't outspend a multi-billion-dollar fund. You win by playing a different game. Your advantage, the one thing you have they don't, is time. They need to make profits this month, this quarter. You can think in years, even decades. By focusing on the quality of the business itself, like we talked about with Jack's Coffee Shop, you can simply ignore their short-term games, let them fight over pennies in the milliseconds. You can focus on the dollars that are made over years. But sometimes this manipulation isn't a secret computer game. Sometimes it's a very loud, very public scam designed to lure as many people as possible. And that brings us to one of the oldest tricks in the book, the pump and dump. So, we have seen how one big player can secretly manipulate the market with computers and algorithms. But what happens when the manipulation isn't a secret at all? What if it's a loud, public party that everyone is invited to, but only the hosts know it's a trap? To understand it, we first need to look at its simple, brutal anatomy. A pump and dump has two parts. First, the pump. A group of insiders artificially inflates the price of a stock or crypto coin using false, misleading, and hyped-up promises. Second, the dump. Once the price is high enough, those same insiders sell all their holdings at once, crashing the price and walking away with all the profits. Now, why do people fall for this? It's because the scam is designed to trigger two of our most powerful emotions, greed and its evil twin, FOMO. When you see an investment skyrocketing and had everyone talking about getting rich, your rational brain just shut down. A pump and dump does not sell you a stock, it sells you a lottery ticket disguised as a sure thing. So how does this actually work in the modern world? The playbook is surprisingly consistent. First, the setup. The insiders will quickly buy a massive amount of an obscure, cheap asset. In the old days, this meant penny stocks, tiny worthless companies nobody had ever heard of. A classic historical example of this is the firm Stratton Oakmont, which you might know from the movie The Wolf of Wall Street. They were masters of using high-pressure phone calls, the original form of hype, to pump up the price of worthless companies to their clients. Today, the playbook is the same, but the tool has changed from the telephone into the internet. We saw this on a massive scale during the crypto boom of the early 2020s. Insiders would create a new coin, buy up most of the supply of fractions of a penny, and then unleash the marketing machine. This is the pump. They flood social media, TikTok, Twitter, Discord, Telegram with posts like "This is the next big thing, 100x gains, get in now or stay poor." They might even pay influencers to promote it, creating a tidal wave of hype. As thousands of regular people driven by FOMO start piling in, the price explodes, and then comes the dump. Once the price hits their target, the insiders who started it all sell everything. The huge sell-off instantly evaporates all the demand, and the price crashes, often by more than 99% in a matter of minutes. The insiders walk away with millions, everyone else is left holding a worthless bag. In a pump and dump, you are not the investor, you are the exit strategy. With that being said, how do you protect yourself from getting caught in one of these traps? The good news is the red flags are usually bright and obvious if you know what to look for. First, look for urgency. Are they pressuring you to buy now before it's too late? A real investment opportunity will still be there tomorrow. Second, listen for the guarantees. Anyone promising guaranteeing profits or 100x returns is either lying or delusional. There are no guarantees in investing. Third, check the substance. What does the company or crypto project actually do? If you cannot find a clear purpose beyond the price will go up, it's likely all hype. The ultimate defense is simply skepticism. If an opportunity sounds too good to be true, it almost always is. But here's a scary thought. Sometimes this collective hype isn't started by a small group of scammers. Sometimes the entire market, including the so-called experts, can get swept in a mass delusion, creating a massive bubble that inevitably has to pop. And that devastating phenomenon is exactly what we are going to break down. We have seen how pump and dumps are like a planned, controlled demolition designed by a small group of scammers. But what happens when the mania isn't planned? What happens when the whole world, from your neighbor to the biggest experts on TV, all get swept up in the same fantasy at the same time? That is when you get a financial bubble. And every single bubble in history, without exception, has one thing in common. They always pop. To understand this, we have to look at the psychology of mania. A bubble is when the price of an asset, whether it's stock, real estate, or anything else, gets pushed to a level that is completely disconnected from its real underlying value. It's a market driven by emotion, not by facts. Bubbles typically follow 5 predictable stages. First, there's a displacement. A new exciting technology or idea appears that captures the public's imagination. Then comes the boom. The media starts covering it and prices starts to rise. Then comes the most dangerous stage, euphoria. This is the peak of the madness. Stories of overnight millionaires are everywhere. People quit their jobs to day trade. Your taxi driver starts giving you stock tips, and you hear the 4 most dangerous words in finance. This time it's different. After that, the smart money starts quickly taking profits, and finally, the pop. One event triggers a wave of panic, the selling snowballs, and the fantasy evaporates. A bubble isn't fueled by numbers on a separate sheet, it's fueled by a story that comes too good to resist. This pattern has repeated itself over and over throughout history. Let's look at the dot-com bubble in the late 1990s. The exciting news story was the internet investors went crazy, throwing billions at any company with a .com in its name, even if it had no profits or even a real product. They were not buying a business, they were buying the dream of the internet. When the bubble popped in 2000, solid companies like Amazon survived and thrived, but countless others, like the infamous Pets.com, went straight to zero, wiping out trillions of dollars in wealth. Just a few years later, we had the 2008 housing bubble. This time, the story was that real estate prices can never go down. People bought multiple homes they couldn't afford, using risky loans because they believed they could sell them for a profit in a few months. When the bubble popped, it didn't just crash the house market, it triggered a global financial crisis that we are still feeling the effects of today. In both cases, people ignored fundamental value and choose to believe in a fantasy of easy money. The lesson is that when everyone is thinking the same thing, someone isn't thinking. So with that being said, how do you protect yourself from these inevitable cycles? The hard truth is, you cannot predict when a bubble will pop, but you can choose not to participate in the mania. The defense is to be a disciplined, long-term investor, not short-term speculator. Don't chase what's hot just because everyone else is. Don't invest your life saving into something you do not fundamentally understand. And if you see euphoria all around you, if everyone is bragging about their easy profits and telling you you are a fool for not joining in, that shouldn't be a signal for you to jump in. That should be your signal to be more cautious than ever. Whether it's institutional manipulation, a social media scam, or a full-blown market bubble, the dark side of market always preys on the same human emotions: our greed, our fear, and our impatience. And my goal here is not to scare you away from investing, it's to arm you with the knowledge to navigate it safely. If there is one lesson to take away, it's this: treat the market like a profession, not a casino. You get paid at your job because you show up and learn consistently. The market is no different. Real returns are earned through the experience you gain over time, not by just showing up and hoping for the best. Be patient and be safe, and let me know your biggest takeaway in the comments below, and I will see you in the next video.